Felix here. I owe you an apology. I put out an NVIDIA video yesterday, and after I watched, 5 public presentations or so from the last 7 days of NVIDIA, so many product launches, so much cool tech. So I did some maths on the back of a napkin on the beach, and I thought, wow, they could easily add $1 trillion in revenue. My mistake was that I'd added 3 zeros. So I thought, well, they could make 9 trillion. Really, they can make 9 billion on bill case valuation of those virtual factories. So the lesson here is even the most rational minds are prone to irrational thinking when it comes to money. I got swept up by the AI excitement and I used trillions where billions were needed. So why am I making this video? Just to grumble? No, I want to share with you the 3 laws of investing that I've learned. That didn't apply yesterday. And at the end of which, I'll also share with you 2 key charts on what NVIDIA is really worth. And remember, I used to be a terrible investor, and then I became an investment banker, which opened my eyes to the real world of Wall Street, a cutthroat system designed to take from retail investors and hand all the money over to hedge funds and banks. And when I left banking, I decided I'd share that knowledge so that you too can enjoy taking a stroll through the mean streets of Monaco here on a Wednesday afternoon and live the life you deserve and enjoy yourself. So I give you the 3 laws of investing. Number 1, the law of gravity. We think we can all agree that Sir Isaac Newton was a pretty smart cookie. His achievements in mathematics and science are really up there with the greatest minds in history. The law of gravity that he formulated, essentially explaining how objects attract each other based on masses and distance. Calculus is pretty much his. He co-developed calculus, which is a mathematical tool for studying change and calculating areas and volumes. And the telescope, the reflecting telescope, he essentially inserted mirrors to improve image quality and enhance astronomical observations. Optics, color theory, okay, we're getting a bit more obscure here, but he did some really cool experiments with lights and prisms, discovering that white light is composed of different colors. So what you learn in physics is all Newton. He also formulated the laws explaining how objects cool down based on temperature differences. And so, smart cookie. Philosophy, all sorts of stuff we can add to that. But what many people don't realize is Newton was also an investor. And while he was lauded for his scientific discoveries, Newton is also remembered for his lack of investing acumen. In the early 18th century, the South Sea Company had a monopoly on trade with the Spanish South America, and it saw its stock prices go to the moon. Newton entered that market early and bought the South Sea Company shares, making a huge profit. However, as the stock prices continued to soar due to greed and speculation, Newton decided to sell his shares to secure his gains. Unfortunately, seeing others make even more money, Newton became fearful of missing out, Newton FOMO, and he made the classic mistake of then panic buying at the top, buying the shares at a much higher price than he had exited. And soon after Newton's reinvestment in the South Sea, the bubble burst. The stock prices plummeted, causing massive losses to investors who'd bought in at really inflated prices. And Newton wasn't spared that. He suffered significant financial losses, about £20,000 sterling at the time. That's about 5 million quid, which for a mathematician and philosopher is a fair bit of change. Now, a sure way you can prevent such losses yourself is to simply subscribe to this channel. Now, law number 2, Metcalfe's law. At the peak of the height of the dot-com bubble in the late 1990s and the crypto bubbles in 2017 and 2021, every investor and their uncle was citing Metcalfe's law as the reason to be all in on tech and magic coins. And Metcalfe's law states simply that the financial value of a telecommunications network is proportional to the square of the connected users. All clear? Well, the value of the phone grew exponentially with each new user who connected to it in the late 19th century, and the same was thought to be true about the internet. And it's true, it was true, but it wasn't quite fast enough to justify the 1999 valuations. As usual, investors jumped in a little too early, and at the height of the bubble, look at Amazon. It was trading at $100. A year later, it was changing hands at $6. So were the early investors wrong about the potential of the internet and Amazon's dominant market position? No, but they were early. And being early in investing is really the same as being wrong. And I'll pop in an Amazon chart here for you so you can see it. In fact, it took a decade for Amazon stock to surpass $100 again. And even then, the investors that bought at $100, well, they could have 20x their money over the next 20 years, which is amazing. But had they held on a little bit longer, they could have made 40,000%. A bit of music here too. And that's because they ignored the second rule of high growth tech investments. And that's Amara's law, and that's the third one we're going to go through here. And it's named after Roy Amara. And it's a principle that describes our tendency to be out of breath, to overestimate short-term impact of technology and underestimate the long-term impact of technology. And Amara's law basically says we get too excited about the immediate potential of tech or the investment opportunities, and we come up with sort of unrealistic valuations because of it. And usually what happens is new technology, look at Zoom, right, or any other of those sort of telecommunication platforms that allowed us to talk to each other virtually, and people got very excited by this, much as I'm getting a lot of breath. And why? Because the technology seemed to solve a problem so effortlessly that we got just really excited about it. So we come up with this tunnel vision to think that the product's amazing, there's nothing wrong with it, it's the perfect solution to everything, and we stop perceiving anything negative. So no matter how amazing a new bit of technology is, there is usually something negative in the company or the stock. So because we come up with a mindset that nothing could ever go wrong, that Tesla does or Zoom does or NVIDIA does at the moment, the technology becomes incredibly popular because everyone's talking about it in a very, very short period of time. Everybody we know is invested in it or using it. Let's have a look at that nice bit of architecture behind me there. Can you see that? Little palace up there. So if you remember, beginning of COVID, people were going to work masked up, socially distancing, or working sort of weird rota to avoid one another in the office. And lots of people were trying to do their work through email and WhatsApp, which doesn't work very well because you don't get emotions across, and the descriptions usually aren't very, very good, which is why platforms like video are much better. So Zoom comes in, and Microsoft Teams and a bunch of others. And well, that wasn't really new. I mean, we had Skype for a while. These niche products suddenly became huge because with COVID-19, we were super, super excited that we can now work from home and we could communicate the way we wanted to. We could have our conference meetings and so on. And it was used by all major companies and friends and relatives and everybody else. But the enthusiasm wore off at some point. And that wasn't really surprising because while there was an obvious and compelling need for the technology, for Zoom in early 2020, I mean, we had like the sort of second version of the Spanish flu, anything like we'd seen in 100 years. And we were all told we were all going to, shrivel up and die if we didn't wear masks and that kind of thing. And what happens is that the amygdalas in our temporal lobes essentially go into overdrive. they send distress signals to the hypothalamus, which then responds by flooding our system with tons of adrenaline, right? So we get that, wow, we'll never touch grass again. The office is a thing of the past. And, we'll be confined to our homes forever till the end of time. Now, driven by that irrational fear, we then extrapolated the current situation out over years, maybe even decades, and arrive at a share price reflecting the worst possible outcome for humanity and the best possible return on capital. And a formerly almost unknown video software had a market cap of 160 billion and went up 840% in 12 months. Now, we did get to touch grass again, thank God, and many people returned to the office. I'm very, very sorry for you. And we returned to bars and restaurants and enjoyed ourselves, thankfully. And after peaking at $589 a share, Zoom then, traded 89% lower to $65. There's a bit of view behind me here. So what happens with the stock now? I'm talking NVIDIA. Honestly, I've got no idea. And I'd be very, very skeptical of anybody who claims that they do. Yeah, sure. I mean, GME went to 350. Peloton, who glued an iPad to a bike, reached a 47 billion valuation. I didn't see that coming. And a lot of money was made in that. I mean, a lot of people made a lot of money, especially the hedge funds. But that's only if you leave the disco while the music's still playing. And that doesn't happen all that often, at least not in my experience. So should we not follow the AI trend, or should we not invest in AI? Of course not. I just think we need to remember the 3 laws here when you do like that investment. And this particular video here is based on a newsletter that we published at tradingfloorwhispers.com. And if you enjoy this kind of deep dive, real trade walkthroughs and much more investment insight from investment bankers, then subscribe to the free trial at tradingfloorwhispers.com. That's tradingfloorwhispers.com, also linked down below. As for NVIDIA, well, it's trading at 43 times forward PE. That's about average for the last 6 years. Revenue is expected to hit 83 billion in 4 years. That's 12 times the current stock valuation, and lofty. But if they pull off the predicted 60% profit margin, well, then that's a PE of 20x, or 4% return on capital. And don't worry, I used the calculator for the maths this time. That's looking more reasonable, right? But that's already priced in. So they need to do more than that. They need to significantly beat expectations. Possible? Sure. AI might just come up with better ideas or a better business model to allow NVIDIA to reach much, much loftier profitability goals. Learn how to boost your portfolio and your career with the biggest generational shift in like 100 years, AI. Watch this next video. It's the most important one I've ever recorded.